first couple chapters of intermediate accounting are really going to be a review from what you learned in financial accounting. So hopefully we can move kind of quickly through them. So it talks about the basic role of accounting. Again, it's necessary in every business, doesn't matter what type of business it is, to help them make good decisions so that they can be profitable and they can, feed their profit back into their employees and into the community. And so our focus in accounting, we look at the different people who use this financial information. So investors, people who are going to buy stock in the company, they definitely want to know how the financial background of that company is doing. People who are loaning them money, creditors, so either banks or vendors, and any other type of external users. So like the IRS could look at their financial statements. Any regulatory type body could do that. So really, though, the goal is to look at the financial data so that they can make good decisions, whether it's investing or lending. So we'll go through our financial statements. I think that's going to be more in chapter 2, but we'll talk about the four most important ones are our balance sheet, our income statement, our statement of cash flows, and our statement of retained earnings or stock or shareholders' equity. So then the companies are going to prepare those financial statements. And again, notice on here it has not only profit-based companies, but not-for-profit, so government entities, charitable organizations, colleges, universities, schools, all prepare financial statements. Even households, if you go to get a mortgage, they'll ask for financial statements. I mean, not necessarily prepared the same way businesses do, but all that information. And again, who uses them? So banks, investors, suppliers, customers, government regulatory agencies. And mostly what we are going to be talking about in this class, like we did in financial accounting, is corporations. So corporations are, larger forms of business that are looking for investors to buy their shares of stock or that they could issue out bonds to. So it's not just like a family-owned business, it's a larger, bigger company. So those investors are who then provides the capital to those businesses. Again, when they buy those shares of stock or when they buy bonds, they're providing cash to those corporations. And then what do they get back? They could get dividends, or if it was bonds, they could get interest. So it's a cash flow that corporations are using. And then what do those investors and those creditors look for? If you're an investor, you're looking for a rate of return. Am I making money? So I could make money on my dividends, or I could make money on the price of the stock going up. And then how much risk is involved? Okay, so then our primary objective of financial accounting is that the information that we are providing to these stockholders and these creditors should be accurate, should be useful, should conform with generally accepted accounting principles that we'll talk about. So we want to look at that information, the cash receipts and the disbursements, and how much are the amounts, again, accurate? Are we putting them into the right period? And then is there any uncertainty involved? Following generally accepted accounting principles, we normally don't record stuff if it is uncertain. Whoops, sorry, too far. So again, cash basis accounting is going to be more small businesses. They truly only record the transaction when the cash comes in or when the cash goes out. When we are in our corporate financial accounting type mode, it's all accrual based accounting. So we are going to record our revenues and our expenses when we have the dollar amount and when we've actually earned them or used them up. So it doesn't matter when we pay them or when we get paid, it's did we actually perform the services and we know the amount. Like I said on a couple slides back, we follow generally accepted accounting principles. We shorten that to say GAAP, GAAP. And those are, again, very very specific guidelines that get into what we are allowed to record and how we're allowed to record it. And if everybody is in the United States is following GAAP, it makes everyone's financial statements comparable and consistent. So who all kind of sets that? Again, here's a nice little diagram of it. But the Securities and Exchange Commission is primarily the SEC. They are primarily the ones who oversee any publicly traded company. So here they give you, again, some historical acts that kind of set this up, and then, again, allows the Securities and Exchange Commission to govern that. So I'll let you kind of read the history of all that over. So we'll kind of skip through these kind of quickly. But again, if you go back to your textbook, and it gives you all these details of the dates and the task force and all that type of thing. And there's also a Government Accounting Standards Board. So we have the FASB, the Federal Accounting Standards Board, but there's also one for government, because government is a little bit different. And there's different codifications. So if you're looking up a specific FASB code, like they're numbered in a certain way, so you can go and find those on their website if you'd like to look those over. Then we get into International Accounting Standards Board and the International Accounting Standards, because again, so in today's world, so many businesses are doing business internationally, and we're making investments in international companies. So we want to know that they too are following a set of accounting standards. So there's different, here again shows you the different types of like how they're set up and who oversees them. So we've got GAAP versus IFRS. So again, IFRS is the international, and we try to get them as consistent as possible. I always feel like GAAP is much more detailed. IFRS is a little bit more general, again, because you're trying to bring in all of the countries together, so that they're somewhat consistent in those international standards, so that, bring those converged standards in. But as it says, like full conversion, I don't think is really going to happen. We used to, I don't know, I feel like 10 years ago, we'd say, oh, it's on the horizon. I feel like it's going to be a difficult thing, as long as they are still somewhat consistent and have a general overview that carries forward. And then here again gives you the FASB's, the Financial Accounting Standards Boards, their steps in how they set these standards. Excuse me. And then there's definitely a lot of political pressures when we're talking about international, again, because it's not just one nation. We're trying to bring the whole world basically together, and all of the different countries that make up Europe to follow those same standards. So there's definitely obviously going to be political things that go involved in that. Okay, then we'll get into, again, high quality financial reporting, because again, Securities and Exchange Commission wants those high quality reports so that investors like you and I don't lose our money and that we know what we're getting into. So one of the ways that they do that is that publicly traded companies all need to have an audit at the end of the year. So the auditor is going to be an outside third party that comes in and looks at those financial statements, and they express an opinion to say, hey, are these in accordance with generally accepted accounting principles? And then the auditor, again, think of our big accounting firms in the United States. They basically want everyone to be CPAs. So it's going to be add some credentials to that. There's been many accounting scandals in the news in the past 20 years, and those have pushed back onto like the Securities and Exchange Commission to govern these companies a little bit more closely, and to set up some Sarbanes-Oxley Act and to do some different internal control procedures. So then here we've got a move away from our rule-based standards to more objective-oriented or principle-based type standards, so that, again, there's a little bit more professional judgment in there. However, when anytime you get into a little bit more of professional judgment, that leaves room for fraud. Again, depends on the ethics of the company. So then that's why we get into the code of ethics, which is very important. So we've got a variety of institutes that you could belong to. So there's the American Institute of Certified Public Accountants, the AICPA. So if you're going to be in public accounting, that would be an association to join. The Institute of Management Accountants is more if you're going to work inside of a business, so like a corporate accountant. And then there's also the Institute of Internal Auditors. So if you worked within a business or a bank and you were doing audits inside. So each one of those associations have their own code of ethics that spells out exactly what they expect of the people who are members or associates with their agency. But basically, I mean, even if you don't belong to any of those professional organizations, you still want to be able to make ethical decisions. So here kind of gives you steps to go through to just understand, okay, what is the situation I'm in? Is there an ethical issue at hand and who's involved? So then you would identify, okay, what are the values that guide this particular situation? And then pick your appropriate course of action. Then you're going to evaluate the consequences of these different courses of action and then make a decision. So then here again is just a little bit more about talking about the, excuse my dog there, the FASBs and our financial accounting concepts and the conceptual framework. That again takes the different characteristics and then creates our financial statements accordingly. And then we're going to talk a little bit more about these in future slides, the details. Okay, so I'm going to skip over that one too. Like it's all the same slide, so I'm going to just skip through those a little bit. Okay, so then now we get into our qualitative characteristics of financial information. So the ultimate goal we see is to make useful decisions. So is it relevant to make that useful decision, and is it accurate or faithful? So then what makes it relevant? Is there any predictive value, confirmatory value, and then materiality? So normally with financial accounting, if there's anything that is not, like say there's a lawsuit and we think, okay, we might lose, but we don't have an amount yet. I mean, if that's a little bit more predictive in nature. So we may disclose that, but we may not put the dollar amount because we don't have it yet. Materiality is what type of a dollar amount is going to make a difference to an investor or a creditor. Again, depends on the size of the company. Faithful representation, is it complete? Is it free from error? And is it neutral? So again, you're not trying to bias one person or another. Then we get into, these are some things that we talk about in basic accounting, that we want consistency and comparability between our accounting periods. We want everything to be recorded timely. That's why there's closing at the end of the month and everybody wants to get everything in. Everything has to be verifiable. These accounts are all audited at the end of the year, and then it needs to be understood and not like too complex. So think about some businesses have very complex accounting processes. So we want to make sure that everything is understandable.